The Rockingal Show.
Hi, my name is Zira. On this podcast, I'm going to talk to you about how you can start investing with little money. Here's a common phrase I hear about investing: I'm going to start investing when I have real money to invest. I've heard this from many friends and readers who believe they don't have enough money to start investing. But the idea that you have to be rich to invest couldn't be further from the truth. You should be thinking about investment strategies as soon as you start making any money. It's understandable that you may be confused about investing when you have competing financial priorities. You may have debt or you may not have any savings yet. But apart from the two recommended steps above, pay off debt, build an emergency fund, it's never too soon to start investing. Your first investment can be a $20 stock purchase. You have to start somewhere. Here are 7 ways to start investing with little money. 1. Try the cookie jar approach. Saving money and investing it are closely connected. In order to invest money, you first have to save some up. That will take a lot less time than you think, and you can do it in very small steps. If you've never been a saver, you can start by putting away just $10 per week. That may not seem like a lot, but over the course of a year, it comes to over $500. Try putting $10 into an envelope, shoebox, a small safe, or even that legendary bank of first resort, the cookie jar. Though this may sound silly, it's often a necessary first step. Get yourself into the habit of living on a little bit less than you earn, and stash the savings away in a safe place. The electronic equivalent of the cookie jar are high-yield savings accounts. It's separate from your checking account. The money can be withdrawn in 2 business days if you need it, but it's not linked to your debit card. Then when the stash is large enough, you can take it out and move it into some actual investment vehicles. 2. Enroll in your employer's retirement plan. If you're on a tight budget, even the simple step of enrolling in your 401k or other employer retirement plan may seem beyond your reach. But you can begin investing in an employer-sponsored retirement plan with amounts so small you won't even notice them. For example, plan to invest just 1% of your salary into the employer plan. You probably won't even miss a contribution that small, but what makes it even easier is that the tax deduction you'll get for doing so will make the contribution even smaller. Once you commit to a 1% contribution, you can increase it gradually each year. For example, in year 2, you can increase your contribution to 2% of your pay. In year 3, you can increase your contribution to 3% of your pay, and so on. If you time the increases with your annual pay raise, you'll notice the increased contribution even less. So if you get a 2% increase in pay, it will effectively be splitting the increase between your retirement plan and your checking account. And if your employer provides a matching contribution, that will make the arrangement even better. If you're at a complete loss, companies like Bloom offer hands-off investment management of your 401k. 3. Open an IRA as well. Employer-sponsored 401ks are great, but they don't offer the same tax benefits as other retirement accounts, which is why opening an IRA is also important. For starters, you'll have more investment options, since you're opening your own personal IRA rather than going through your employer, who determines your investments for you. In addition, one of the very best benefits of an IRA or a Roth IRA, specifically, is its ability to grow tax-free. Your account will both grow without being taxed, and you'll be able to make tax-free withdrawals starting at age 59 and a half. 4. Let a robo-advisor invest your money for you. Robo-advisors entered the investing scene about a decade ago and make investing as simple and accessible as possible. You don't need any prior investing experience, as robo-advisors take all the guesswork out of investing. Robo-advisors work by asking a few simple questions to determine your goal and risk tolerance and then investing your money in a highly diversified, low-cost portfolio of index funds, mutual funds. Robo-advisors work by asking a few simple questions to determine your goal and risk tolerance and then investing your money in a highly diversified, low-cost portfolio of index funds, mutual funds and/or bond funds. Robo-advisors then use algorithms to continually rebalance your portfolio and optimize it for taxes. There's no easier way to get started in long-term investing. Most robo-advisors require very little cash to get started and charge modest fees based upon the size of your account. All offer automated investing plans to help you grow your balance. If there's any downside to robo-advisors, it's cost. Robo-advisors charge an annual fee equal to a small percentage of your balance. The industry average is about 0.25%. So, if you invest $10,000, you'll pay $25 a year. That's not a lot of money, but it begins to add up if you amass hundreds of thousands of dollars. It's important to note that robo-advisor fees are on top of the fees charged by the exchange-traded funds ETFs that robo-advisors buy to make up your portfolio. You can avoid paying the robo-advisor fees by building your own portfolio of ETFs or mutual funds. For the vast majority of investors, however, that's a lot of additional work and responsibility. The bottom line? Robo-advisors are cheap and well worth it. 5. Start investing in the stock market with little money. Investing in the stock market can take many forms. It doesn't necessarily mean buying individual stocks. Investing in the stock market can also mean buying index funds or mutual funds. Index funds and mutual funds are baskets of stocks where your small investment can buy a piece of the whole. Index funds follow an index such as the S&P 500, and include the same companies in the same proportions as the index it's following. They are passively managed, sometimes even managed by a computer, that simply follows the index. Therefore the management fees are typically quite low. Mutual funds are also groups of stocks that you can buy into, but they are actively managed, and rather than following an index, they follow a set of objectives set forth by the company. For example, the fund may only invest in growth companies. Or perhaps income is the objective, so it will only invest in dividend stocks. Of course, you can also invest in individual stocks. There are increasing numbers of options that have swung open doors to a new generation of investors, letting you get started with as little as $1 and no trade commissions. In the past, stockbrokers charged commissions of several dollars every time you bought or sold stock. That made it cost prohibitive to invest in even a single stock with less than hundreds or thousands of dollars. In fact, $0 commissions have been so successful they've disrupted the entire investing industry and forced all the major brokers from E-Trade to Fidelity to follow suit and drop trading commissions. Plus, the ability to invest in companies with fractional or partial shares is a complete game changer with investing. With fractional shares, it means you can diversify your portfolio even more while saving money. Instead of investing in a full share, you can buy a fraction of a share. If you want to invest in a high-priced stock like Amazon, for instance, you can do so for a few dollars instead of shelling out the price for one full share, which, as I say this, is around $2,434. 6. Dip your toe in the real estate market. Believe it or not, you no longer need a lot of money or even good credit to invest in real estate. A new category of investment known as real estate crowdfunding makes it possible to own fractional shares of large commercial properties without the headache of being a landlord. Crowd-funded real estate investments require larger minimum investments than robo-advisors. For example, $5,000 instead of $500. They're also riskier investments because you'll be putting that entire $5,000 into one property rather than a diversified portfolio of hundreds of individual investments. The upside is owning a piece of a real physical asset that's not necessarily correlated with the stock market. As with robo-advisors, investing in real estate via a crowdfunding platform carries costs that you wouldn't pay if you bought a building yourself. But here, the advantages are obvious. You share the cost and risk with other investors and you have no responsibility for maintaining the property, or even doing the paperwork to buy it. I think real estate crowdfunding can be an intriguing way to learn about commercial real estate investing and also diversify your assets. I wouldn't lay all of my money on these platforms, but they do make an intriguing alternative investment. 7. Put your money in low initial investment mutual funds. Mutual funds are investment securities that allow you to invest in a portfolio of stocks and bonds with a single transaction, making them perfect for new investors. The trouble is many mutual fund companies require initial minimum investments of between $500 and $5,000. If you're a first-time investor with little money to invest, those minimums can be out of reach. But some mutual fund companies will waive the account minimums if you agree to automatic monthly investments of between $50 and $100. An automatic investing arrangement is particularly convenient if you can do it through payroll savings. You can typically set up an automatic deposit situation through your payroll, in much the same way that you do with an employer-sponsored retirement plan. Just ask your human resources department how to set it up. Thank you for listening.
I hope you found this podcast informative. If you have any comments about this or the other episodes, please comment where available. I'll be looking forward to reading them. You can find this podcast on your favorite apps. This podcast can also be seen on my YouTube channel. The link is in the description below. Until next time, goodbye everybody. The Rockingal Show.